Hello, I'm Terry Savage, and welcome to Friends Talk Money. We're going to do something completely different today, and I'll explain in just a minute. You know, we're always three co-equal hosts, and lots of times we have guests or we talk about topics where one of us has some special expertise. But today we're changing it up a little bit. Our guest is going to be Pam Krueger herself and in person. And I want to do the kind of introduction I would have and explain why you really want to stay tuned for this discussion, not about financial planning, but about financial planners, about how to find one, about what questions to ask, what they should ask you, what it should cost. And that is Pam's great area of expertise. You know her from her television appearances. She's widely respected in the financial world. But way back, gosh, a long, long time ago, Pam created something called Wealthramp. Wealthramp.com is the website. When she first told me about this, I rolled my eyes and said, good luck, you go, girl. She said, I am going to match up trusted, fee only, not commercials, not selling you stuff, not getting kickbacks, not taking trips to Hawaii, fee only, fiduciary. And that's a big buzzword in the industry, but these are advisors who will definitely put in writing that they will put your interests ahead of their own, fee-only fiduciary advisors. I joked about it, and it's up on my website, one of the key boxes to connect with Pam. I joked about it as sort of a match.com for people you could trust. And just to explain, starting in 2019, Pam now has more than 230 independent RIA, registered investment advisor firms across the country, and has made more than 25,000 matches or referrals. Okay, now I know that was a long-winded introduction to someone you all think you know, and Richard and I know Pam so very well. But Richard, let you chime in on the intro before we start questioning Pam as a guest. You've watched Pam grow Wealthramp. What else would you add to the intro?
Well, the other thing I would add is I love the questionnaire that I actually filled out over the weekend for Wealthramp as though I was going to sign up just to see the experience, because she asked some interesting questions that I think more people should be asked before they're choosing a financial advisor. Like, well, what's your outlook for the future? Do you look at things as a glass half full or a glass half empty? And I don't think I've ever talked to an advisor who's ever asked me that question. Or how often do you expect to hear back from the advisor? How fast should they be responding? So what I liked about it was it wasn't only about, well, are you a conservative investor? Are you aggressive? Are you risk averse? That's part of it, but that was not all of it. So I applaud this because I feel like, the questions that Pam's asking is really going to help people find the right match, not just somebody who can make the money.
What made you start Wealthramp?
I've said this so many times. I actually didn't even want to do this. I only did it because I knew that this is a problem for people. I was hearing from people. They were telling me, Pam, there are lists. You're always telling us, Terry Savage is telling us, Rich is telling us, everybody's out there who we respect telling us that we need a fiduciary advisor who is 100% fiduciary all the time and commission free, means fee only, that they work only for the client. And they said, the problem is that there are lists. There is the NAPFA, which is an association of these advisors. There are other places you can find long, long lists, but they were telling me it's not helping me, because have these advisors, beyond just being fee only, have they been vetted? How do I know that they're being monitored? How do I know which one of those might just give me the flick and say, I'm sorry, you don't have enough money for me? I don't want to have an awkward conversation with an advisor I call out of the blue from a list, and that advisor says, ho, 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 you don't have $500,000 at least? I'm sorry. So, Pam, can you help us? This was when I was doing Money Track, when I had the Money Track series. And my initial response to it was, I can see that that's a problem. I don't know how I could help. But then I kept hearing that it was a problem persistently, especially as people are getting closer and closer to retirement, and the stakes are getting higher and higher, and the decisions they're going to be making about their money are becoming more important. So therefore, the person they're going to rely on is even more important. That's a big decision. So I decided, I talked to you early on. I talked to a few people I trust early on, and I said, gee, should I do this? And then in 2019, it took me 2 years to curate this network. These advisors don't work for me. These are independent advisors. I want to keep it that way. I want to know that I have these advisors that are in a network that's stable, who I get to know more deeply all the time, that I have vetted and brought together with a constellation of different types of expertise, helping different types of people solve different types of financial problems at different ages.
Before we go any further, because there's so many questions, I have two big questions. First of all, explain to everybody how Wealthramp works. Where Richard, you just referred to the website where you let Pam know information, but there are many places where you put this stuff in, and 40,000 agents, insurance agents. I mean, all you have to do is ask about a mortgage rate or ask about what life insurance would be. We need your name, address, and zip code, and 400 insurance agents call you. That's not how Wealthramp works. Please explain
Right.
the process.
It's really, really important that is not what we're doing. That's called the lead generation business, if you will, or lead aggregation. And they're a completely different business model. So they share Richard's information. When he came in, I asked Richard about 1.5 minutes worth of questions that were designed to get Richard thinking about, well, why do I think I want an advisor? How do I, what is it what am I looking for? Do I want a male? Do I want a female? Do they need to be local? Is the glass half empty? Am I optimistic about the stock market? These kinds of things are very helpful. Now, once that's captured, then I have your email. Now, a lead generator is going to share that with the advisors and maybe others. It's worth a lot of money. I can tell you, this is the one thing I can say that I'm so proud of. I am the one and only. Everything's private. So when people come through and Richard's profile comes in, I don't share that. You can see the results. You've got probably 3 advisor results, Richard.
I did. I have not gotten any calls yet.
That's right. You won't, because they don't know that you are alive. You can see them. It's a one-way mirror, but they cannot see you. That protects you. And frankly, how else are you going to go about trying to find an advisor if someone's pestering you? You need to have the ability to take your time, and you have to be the one to reach out to say, you know what? There's 2 advisors here I think I actually want to make a meeting with, and that has to be up to you, the consumer.
Wait, Richard, how would you saw stuff? Explain what you saw when you signed up. You got, so the system, Pam, did you have anything to do with picking the 3 advisors that Richard saw?
I set it up, and I set it up in the first place so that these questions, these answers that came from Richard, that I ask everybody, will then screen out all the advisors out of the 230 who don't fit. And then when Richard sees these 3 advisors, he'll see a photo, he'll see their SEC records right there, and he will see their profile stories. And that's where you'll decide, when you're reading those profile stories, Richard, that's the point at which you would say, this particular advisor, I think I do.
Okay, Richard, what did you see? You said I saw 2 that might work.
What I, as Pam says, what I got were the names and information and faces of 3 potential financial advisors, fee-only financial advisors, who seemed to be a good fit for me based on what I told them about what I'm looking for, what I've got, how I like to work with advisors. And then it was going to be up to me to decide if I wanted to follow up with 1, 2, or 3 of them, or none of them. I'm in New Jersey. They happen to be in the New York, Pennsylvania, New Jersey area, which I thought was a plus. I didn't feel like I would necessarily have to see somebody in person, but I liked the idea to know that I could. And so these were the 3. Now, I didn't pursue it from here because I was doing this for the test purposes of our podcast. But if I wanted to, I would now be ready to start making some calls myself if I wanted to.
Okay, now, Pam, would Richard or any of you out there listening to this, you've got the names and addresses and you say, well, these are interesting people. That makes sense. You just expect that the person will then pick up the phone and call Sam and Joe and Mary, the 3 advisors? how should the person proceed in getting in touch with the advisor?
I'll explain more about how Wealthramp works, and then we can get to the questions about what to ask the advisors. So what happens next has to be, I won't do this unless it's going to be up to the consumer to make the call or to make the meeting or to book the Calendly, to click the button that says talk to this advisor. Okay, I don't know, Terry and Richard, if you are going to reach out to that advisor or not. I will email you. You're not going to hear from the advisors because they don't know you exist. I'm going to email you. Hi, Richard. It's Pam Krueger. Thanks for coming by. Do you need any help? I'm here if you need me. I get calls from people all the time. Oh, I didn't know what to do next, whatever. Now, X percentage of them, may call it 40%, are going to pick up the phone, or not pick up the phone, but click the button and schedule the meeting right there. And then when that does happen, I expect that advisor, because I am the one who set this up and they're getting a referred client from me, I expect them to give me a referral fee, but I don't want the referral fee when they meet someone. I don't want it when they sign up. I want to get paid. Usually 3 months goes by, and I want to make sure the relationship has settled in. Once it's settled in, I am expecting that the advisors are going to send me a referral fee as per our contract. They are not allowed to punish the client and bump up their fee because they have to pay me something. They have to pay me the referral fee as per our contract. But here's the rub. I don't have any legal way to check in to see what's really happening between the client and the advisor at that point, because it's offline, it's gone. I can't check their accounts. I have to rely on the honor system. And guess what? It works because I'm cash flow positive and they want to pay me and they want to stay on the platform. And frankly, they're all on the same mission that we are on here. And that's why they're part of Wealthramp.
Wait, you skipped something. Wait. Just let me just get one more thing in. Yeah. So now Richard, or at any of us who goes on, gets 2 or 3 names. I know I've talked to you where you said, Terry, I talked to Mrs. Jones. She signed up. She came from you and I talked to her. She was torn between 2 different planners or something like that. You're also talking to people. Some reach out directly to the advisors and go, great, let's meet, or they meet with 2 of them.
Most do. But like right after we get finished recording this podcast, I have a meeting with someone who wants to talk to me, who's like Richard, who came through and might have a question about something. I literally just got off the phone with someone before we started recording who's in the Chicago area, a business owner. If I told you the name of their store, you would recognize it. And they came through, and Tom had a question for me. So I want people to know that they can reach me directly if they need to. Most people don't, but some people do. And they want to ask questions and they want to, just get a little bit more info.
Well, Pam, how do the advisors get on your list to begin with, the big list, not the whittled down to 3 list? And how do you get all the information about them?
So that I'm so happy that you asked that, because let's start at the top, because there are the questions at the bottom that you would need to be asking an advisor once they are vetted. Now we're talking about the vetting questions. How do you vet an advisor? You start by weeding out. It's all a screening out process, because there are approximately 500,000 individuals in the United States that self-identify as financial advisors. However, 90% work for brokerage firms or work for insurance companies. It doesn't make them bad people. It just means that they're more sales reps. They're back in the old days. Do you guys remember the name broker? The reason they were called brokers is because they are and were and have been intermediaries. They work for the brokerage firm, and their job is to recommend that firm's products that could work for you. That has nothing to do with advice. So advisors, there's only 10%. So say that are fiduciary and fee only. So call it 60,000, roughly 60,000. So now, how do you take a list of fiduciary advisors who claim to be fiduciary and fee only? How do you sift that list down? The way you start is you screen out from looking at their what's called their form ADV. It's right on my website for every advisor. You'll see the records right there.
From the SEC, Investment Advisor Registration. They have to say all that.
This is where it's not their fluffy website. It's their SEC filings. So they have to describe what are their fees, what is their business, what do they provide, what do they do. When you read that tip to tail and you take a yellow highlighter and you go through, you're looking for things to screen out and to screen in. And Richard, I'll tell you what, it's really quick, because when you see that they sell insurance, when you see that you're looking at the fees they charge, doesn't make sense. So right there, that's the first level of screening. And then from there, it requires pulling all the pieces together of what I can see and then having an interview with the firm, interviewing the founders. I want to know, what's your backstory? Who are you? Where did you come from? Why did you start this firm? I need you to have 10 years experience. I need you to have this firm be established the way it is for at least 5 years. There are a multitude of questions. I need to understand that you have a client retention rate that is not below 98%. Think about that. Client retention rate, 98%. I want to know what kind of software you're using to do your retirement income calculations. I want to know why you're using that particular software. I want to understand exactly who your clients are, how you charge your fees, how many clients are you willing to take on before you say, I'm at capacity. Please don't send me any more referrals because I need to spend time on the clients I work with now, because these are advisors who get paid by their clients to work only and directly for their clients.
And if they've had a problem with the SEC or with the state regulator, does that take them out of the system?
Yeah.
Most of the time, if I'm being honest, yeah. But I've also met, some great advisors. I had one in particular that I kept. He had a black mark. What was it? Go look. It was back when he was 21 years old. He was arrested during some sort of fraternity prank. They took down a stop sign or something. Well, they never took that off of his record. So I made an exception, a common sense exception.
Okay.
And that's silly.
Right.
That's not.
Pam, where are they? Are they all? Let's talk geography for a second. Not that it matters, as Richard pointed out, he would be comfortable in his town, but he's in the East Coast. There's a lot of them. But someone lives in Denver, someone lives in Iowa or Arizona. Do you have advisors all over the country?
Yeah.
And what percent of the time do people want to be in close proximity to their advisor?
About 65% want to be, I want someone who I can know that I can see locally, or I'm willing, in the case of Sal Bauman, for example, at Elodium, where he's in Minneapolis, the firm's in Minneapolis, but he gets to Chicago all the time. So even though his firm is located, headquartered in Minneapolis, because he's from Chicago and he goes back and forth, I would say that that's someone who you're going to have a reasonable certainty of seeing.
But do you have advisors all around the country? They're not just concentrated in New York, Chicago, LA?
No, they're everywhere. They're everywhere. There are some places where I have not had success and I'm not going to settle. So I just finally solved New Orleans. Oh my gosh, thank goodness. But there are places, you guys, where for 2 years, people say, well, why don't you have an advisor here in this particular town? And I say, I can't, because I have not found an advisor who's outstanding. Well, this fiduciary and fee only, I know, but they're not outstanding. They don't meet.
Okay. Oh, good. You led me right to where I want to go. There are some big firms that advertise nationally. Well, they'll go unnamed. We make money when you make money. We're fiduciaries. We're da-da-da-da-da-da. Are any of the firms you have, those monster firms that you see advertised, or you figure people could find them on their own?
No, they don't pass my screens because the fees don't align with what they offer. So in those cases, many times I find that the bigger the firm gets, and I'm not talking about 100 advisors, I'm talking about when they get really, really big, the bigger they get, I've yet to find one that doesn't become cookie cutter. And then what happens, Terry, is they have a lot of overhead. And all of a sudden they're advertising on national TV. So guess what? Their fees tend to be
Yeah.
high. They are fee only.
Yeah. Who pays for those ads? Those are
But
expensive.
yeah, but at the same time, what you're getting tends to get more and more cookie cutter. So you're getting less. So the real question is, and this is what I write about a lot, how do you as a consumer, how do you get your money's worth out of an advisor? Because, Vanguard did a study, a gamma study, they called it a few years ago, that says, hey, everybody, if you work with an advisor, our research shows that you're going to add 3.4% to your portfolio after advisor fees, after net of taxes, net of everything. Woohoo. Problem with that is that, that's an average. And it doesn't work for all advisors. So there are some advisors who are going to be able to not only give you back the fee that you just paid them in terms of value you're getting for your money and return, but they're going to give you more than that. Those are the only advisors that I want on Wealthramp, because
All right.
peace of mind is it.
Okay, now let me change perspectives, all of you who are listening here. But Pam is our guest. She created Wealthramp, this matching firm for fee-only fiduciary advisors she's carefully selected. Now let's talk about you, all of you who are listening, who are going, okay, I guess this is a place I want to go. But how, first of all, what do these financial advisors do? I will start with this. Too many people say, my financial advisor at XYZ brokerage firm told me. And I go, wait, they call themselves financial advisors, but they're either brokers or they're selling stocks, or maybe they're even registered as investment advisors. But a financial advisor, what should all the people that you would match people up with, what's the range of things that they can help you with, and what, as opposed to just investments?
So I'd say 80% of the people who are finding Wealthramp are either, 5 years out from retirement or all the way up through having just retired. 80%. The rest are younger people looking to build wealth or pay off debt and things like that, get going, or deal with very specific and unique situations. So you've got your mid-career people who are like, wow, life is becoming more complex. I really think we should, because I might be married or have a partner, and I really want to have our household really take a big picture look at everything. What that means is that you've got to look at cash flow planning, and you've got to say, today, tomorrow, let's stress test our worst nightmares and make sure that we are never going to run out of money in retirement at the rate we're saving right now, the way we're investing right now. And if it looks like we are going to run out of money when we're 75, if we stop working at 65, what adjustments can we be making? Now that has to align, excuse me, with your tax minimization strategy, that has to align with your investment strategy, your Roth strategy. All of these things have to be combined, and you can't leave out estate planning, and you may have college planning, and you may have special needs. You might be the one with the special needs. Somebody pointed that out to me the other day.
Long-term care planning too.
Long-term care planning. It's health. Like, how am I going to pay for unexpected, like, what if I need memory care? What if my aging parent needs memory care? And I have to worry about my aging parent at the same time I'm worrying about
you can find people that will do all of this. This is not about someone who will say, I think you should buy more tech stocks. This is about the big picture. All of your advisors, your financial planners that you're matching people up with, they may not all be estate planning attorneys, but they have people that they will recommend you to if you don't have your own, or accountants, although they know all the rules about tax-free and taxable and all of that. So the whole idea of this is to get the bigger picture,
You
not
can't
just
have
what
piecemeal.
does my portfolio look right
That's
to you?
right. You can't have piecemeal financial advice. You can't go to this person and get your tax advice and then someplace totally separate to get your investment advice. We can, but you're going to create, a ton of confusion. Richard.
Well, I wanted to talk a little bit about the questions that once people find an advisor or two or three that they think they might want to talk with, the kinds of questions they should ask that advisor to see if it's a good fit and if the advisor might be right for them. So I scribbled down a few things that I would want to ask, and I want to see, Pam, if they seem like good questions to ask or if they're better questions to ask. So a couple questions I would have is for somebody who's near retirement, I think they might want to ask the advisor, what's your strategy for taking money out of retirement plans? Because advisors tend to be so much about accumulating, but not so much about decumulating. So that's one question I would have. Another question I might have is, how do you help your clients with the whole process of making financial moves? So not just advice, but like I just want to sell something and get the money from my from this account to that account. Can you help me do that? And the last thing that I was thinking about is I would want to ask the advisor, how do you define success for your clients? So, how will we both know that it's working? So let me stop there, ask you, what do you think of those questions and what other ones you might ask?
Okay, so let me start from the standpoint of I'm always taking the point of view of the consumer who is talking to an advisor. Just a step before we get to the questions, I want to point out that there is the consumer, the person, the individual, the family who's got a big decision in front of them that's really like all they can think about. They can't think beyond that. They can't even think about retirement. Right now, it's like they need to know if they're going to sell their family home and they've got one big decision that's looming, or I've got an annuity versus a lump sum, and they can't see beyond it. So that person is going to engage with an advisor because they want to have a one-off. They want to have a real situation where they say, I'm going to pay you. I need you to help me, collaborate with me, do the deep dive, help me make this decision.
All right, solve my problem.
Solve my problem. The second person, and then maybe I'll work with you in the future, but I can't see that far right now. Right now, I got to solve this problem. Second person says, I know that I need some ongoing help with the cash flow planning and the tax planning. It's getting a little above my pay grade, but I don't need you to manage my portfolio. I don't want to marry you on the first date. So can't I just pay you to do the financial tax planning and all of everything and give me advice on the portfolio? Sure, I want to hear it, but I don't want you to manage it. And the answer is yes. Then there's that person who has a different set of questions. And then there's the third person who comes and says, I don't want to do any of the maintenance of this portfolio because I don't trust myself to rebalance every quarter properly. I don't know what tax loss harvesting is, and I don't know when to do it, and I don't want to miss timing decisions. Please do the planning and the wealth management, portfolio management for me. But the questions, no matter who you are, your questions, Richard, are excellent. There's absolutely, what is your strategy for taking money out? What's your approach going to be? You're forcing the advisor to describe for you the process and how you're going to work together. But the two questions that I really like are asking the advisor, and again, kind of forcing the advisor to draw you a picture by asking, Terry, you're the advisor. Can you please describe your typical clients that you work with most? What kinds of problems are you helping them solve? And what kinds of aspirations do they have that you're helping them achieve? Draw me a picture of that. So after they hear about you and your situation, just enough of a snapshot, asking that question, it pulls out of them describing what they do for their clients and whether or not that resonates with you, Richard. Does
So
that resonate with
yeah,
you?
so you can see if they've got clients that are like me, and then I'm not going to be so foreign to them that they won't know what to do with me, right?
Yeah.
Because in that answer, that advisor will say many people come to us when they are looking for retirement income strategies to be able to know how to take their money out. So So by asking them to describe the kinds of problems they help solve for the kinds of people they work with, it helps you to sort of say, ah, okay, this makes sense. And then the second question follow on to that is, so tell me about your fees.
Oh yeah,
How are you getting, how do I pay you? How much typically is it? And those are two questions together are going to help you figure out, am I going to get what I'm paying for? Am I going to get value that I'm actually paying for?
Pam, right there. Okay. So everybody listening, I heard them all. I hear you out there saying, okay, well, what should it cost? Now, people ask me that, they post on my blog and stuff like that. What should it cost? Now, some, and we've talked about this, some quote financial advisors, mostly brokers and so forth, charge based on AUM, assets under management. But I take it that's not part of this fiduciary thing. You want a fee that's not just a fee based on assets, because then if they told you to take $1 million and go buy treasury bills, it wouldn't be under their management. How could they charge a fee?
No,
so how do they calculate the fee? And let's take an example of someone. They're a family. They both work. Yeah. They've got about, you could have this now, $2.5, $3 million in retirement accounts. They're in their early 60s. They have a home. They're almost finished paying for their kids' college. They have no real credit card debt. They have some money saved outside the retirement plans.
Okay.
And they don't know what they don't know. How should they be calculated and what should it cost?
Right. Okay. So in the should department, I'm very light in the should department when it comes to how the fees
should.
Because okay. Because the fiduciary and the fee only model does include assets under management. That is a fee only model,
right?
Along with retainer fee or a flat fee, or it could be a percentage of your income, or it could be a percentage of your net worth, or it could be by the hour. So here's how advisors today, most of them, some of them are still, I manage clients' portfolios. Remember that third client I mentioned that says, I don't want to do anything? Some advisors in this network are going to say, that's the only kind of client I work with, because they want to work with the client where they have everything. They're doing everything. But many of our advisors are fee model agnostic. They're fee only. They don't get any commissions. They don't get paid by anybody but you. How do you pay them? What they want to do is they want to look at the scope of the work, whether it's a one-time engagement, a planning only engagement with just some investment advice, or whether it's the third way. You don't have to do assets under management. They can say, let's look at the scope of what you work, the problems you're trying to solve, what you're trying to accomplish. And then we're going to base it on time and complexity. So even if it's assets under management, the fee is going to be calculated based on how much time and how much complexity, how much time of the team am I going to pull into this on the estate planning side? What about the tax side? Do you have something really complex happening? So when they're looking at the ways they can charge, it can be a retainer, be a flat fee. I can discuss that with you. If I'm the advisor, I can sit down and say, Richard, Terry, you're a married couple, and here's the scope of what we want to accomplish, right? Many of my clients ask me if I will manage their portfolio. You said you don't want that right now, at least, maybe down the road. So we can charge you in the following ways. The fee is going to be the same pretty much. I mean, the fee is going to be more when it's assets under management because they are managing the portfolio, but not that much more, because the value is in the financial cash flow planning, tax planning, estate planning.
Okay, so all right, look, now I gave you a sort of a couple. I think that might be our audience.
Yeah.
They're intrigued by this because they know they don't have someone who's looked over their everything. They have their tax guy, they've got their guy. Oh yeah, they did wills. Was it a trust? Was it a revocable living trust? Was it a will? Well, we did that. When was that? Well, the kids were in high school, kind of a thing, So, and we're really happy with our 401ks. Who wouldn't be, because the stock market's at all-time highs. So we just thought we would come to you and see what we might have missed. We'd like to have a first meeting with you. We saw the 3 advisors Pam suggested. We want to have a first meeting. We just like to come in. We don't know what we don't know. That first meeting, is that free? Is that
Oh God, yes. So
Yes.
you can't possibly know if you're going to be a fit, and the advisor, frankly, wants to make sure you are going to be a good fit because they limit the number of clients they have. So they want to make sure they can really help you. So that right there, it's a two-way street. They want to make sure you want to make sure that this is a fit. That first meeting is free. And guess what? If you want to have a second meeting, it's free. The way that you'll know you're starting to get charged is because you will have a fully transparent conversation that says, Richard, Terry, if you want to move forward, here's the next step. You would actually sign something. And until that happens, you're not getting charged a dime. So you can have, I don't want you necessarily to have 4 or 5 hour conversations with advisors, but, certainly more than one conversation.
In-person meetings, Pam, or over the phone or Zoom for the first meeting?
Depends on the person. Most people by phone or by Zoom. Like the gentleman that I talked to, Tom, right before this, we started recording. He's in Chicago and he owns a store, a supermarket. And he said, can I have Tom come to the store? And I said, sure. That's his preference. And then Richard, I promise we won't end this without me answering your question about how do you measure success too.
Okay, but before we get there, we're now on the first meeting. What do the family that I described, 60s, getting ready, blah, 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 what should we bring to the meeting? What should we come to the meeting with, whether it's in person? How in order do we need to have our ducks to have this first discussion?
Sometimes people will be so ready to go that they have their Schwab information or their Vanguard or their whatever, and they'll say, see, I have this right here. But really, the purpose of that first meeting, you don't have to do that. The first meeting is about understanding who do you work with, how do you work with your clients, and let me tell you about myself. Let's see if this is a fit. Tell me about your fees. And then at the end of that meeting or the second meeting, then the advisor will suggest, if you would like to continue the conversation and you want me to take a closer look at, for example, you mentioned you've been with Morgan Stanley. If you want, I can look at your holdings and I can even quickly tell you how much you're paying in those funds that you might not realize. So the conversation has to be organic and go from there. So you don't have to come armed with all of your stuff. Just come ready to express what it is you think you're trying to accomplish and then ask those questions.
I want to push it one more, Richard, just on the amount of money, because this is what everybody writes to me and asks. And I say, it depends. So you can say it depends, Pam, but that family, pre-retirement, $3 million in retirement funds and kids in college and some other savings, and maybe still working, both of them, over $400,000 or $500,000 a year in annual income. That'd be a pretty good client for someone. How much should that family expect to pay all in each year? What should it cost? People just want to know.
Yeah, so it could equate, but it won't at 3 million. It won't. People like to use the benchmark 1%. That would be $30,000 a year for that family. It's not going to be $30,000 a year unless they've got rental properties and they've got, startups and they've got like all kinds of craziness. It's going to be probably somewhere between 10,000, could be 15, could be 20 the first year if there is complexity. That's why you have to look at the scope of the work.
Okay.
Then you have to dial it back from there and say, but it's not going to be 1%. But if you come and you have $300,000 and you have a lot of needs, you're trying to figure it out. Maybe it's not complex, but it's still going to take time. Then you're going to pay the 1%, $3,000 a year. And probably if you're coming from a brokerage firm, you've been paying double that without.
Anyway. Okay, Richard, I'm turning it over to you. I'm sorry.
Well, yeah, and I know we have to wrap soon, but I do want to ask Pam a little beyond Wealthramp itself. I feel like there are a lot of people who believe, I think rightly so, that if you're middle income or have moderate wealth, that it's very hard to find a financial advisor who will talk to you. And I'm wondering what you tell people like that, and are there financial advisors who charge by the hour or particularly look for people who don't have a whole lot of money but do want some help?
Thank you. The answer is Yes. Wealthramp, for example, when I say different types of individuals, I'm not talking about people with $1 million. Do we have clients with 40 million, 50 million? Yes. Do we have clients with 50,000, 25,000, 10,000, nothing in debt? Yes. So how do they afford an advisor? Because we have planners who are specifically, that's their client. We even have accredited coaches. So sometimes someone will come to me and say, I don't think I can afford an advisor, but boy, I need help. And I'll say, you know what? I would really want you to talk with, we have financial coaches you can get matched with and instead who are charging very little, and they're not going to manage your money or anything, but they are going to help really advise and get you squared away. We have plenty of advisors who help people with 100,000, 200,000. They should not feel in any way like they're apologizing. Like, oh, I probably shouldn't have an advisor. Sure, you should. Frankly, you're the person I want to help the most because you're
Right.
the one who, with just the right touch, can get some confidence that you'll be okay. Even if it means the advisor says, let's do this. Let's continue working until you're 70. Here's why. It gives them peace of mind. So there's every asset level that has an advisor.
Thanks, Pam.
Success. Don't let us go without defining that. Is success peace of mind? Is it achieving a return on investment? What is it?
It's peace of mind. It's peace of mind. Because sometimes, as you know, the amount of money is not the definition of that someone's happiness. It has nothing to do with it. It's really got to be that you need to be able to be calmed down and stop worrying, take the stress out. So that's what this is all about. It's about gaining a peace of mind by reducing the stress about waking up in the middle of the night with the monsters under the bed, the money monsters under the bed. What if this? What if that? So maybe you have an engagement with an advisor that sets the course. Maybe they continue on and they help you so you can move and groove and change as life changes. So it's peace of mind. There's absolutely no other reason. And I don't care if somebody has $50 million or if they have 50,000. Doesn't matter. They all want the same thing. I don't want to be stressed out about this stuff. I want to have somebody that I can collaborate with, that I actually like talking to, that takes the stress off. And that's why, you guys, finding these advisors is not just about the things that you think that it's about. It's about finding the advisors who love their clients and will go out of their way. I have one just on Friday, Andy Lawson in Dallas, and he wrote me, and Diane and I a note, and he said, he has an English accent, so I'm going to use the accent. He says, I have to tell you, I did work with this client and they are signing on, but Pam, I hope you don't mind. I can't charge them anything. They can't really afford my fee, but I want to help them. So I'm putting this one down as pro bono. Every advisor in our network does pro bono work.
That's great. Thank you.
Yeah, Pam, I think you've put your finger on it. You did when you started wealthramp.com, matching fiduciary fee-only advisors with people, and the besides all their skills and their talents beyond just money management, but all the broad range of financial planning that you might need. I think you put your finger on it, peace of mind, and that is priceless. Absolutely priceless. It's why I confidently, when people say, yeah, sure, I know a bunch of the advisors. I thought it was great. A bunch of the advisors I know in Chicago, where I'm from, are part of your Wealthramp group, but always work through Wealthramp because I know you will match them up. But to our podcast listeners, we thank you for indulging. I was the one that forced this because I am a big Pam Krueger fan and a big Wealthramp fan. And Richard and I both respect Pam so greatly for doing this. It is a great service. And I hope all of you will just take the time to go to wealthramp.com. At least you know that any of the people Pam chooses or the system chooses for you to be matched with are people you can trust and people who are smart, and people will help you grow into whatever your financial future is that you want it to be. That is priceless. Thanks everybody for joining us. We'll see you soon on another edition.
Thanks, you guys.
Thanks.
Thanks.
Friends Talk Money is funded in part by a grant from the Investor Protection Trust. The IPT is a nonprofit organization devoted to investor education. Since 1993, the IPT has worked with the states to provide the independent, objective investor education needed by all Americans to make informed investment decisions. Visit investorprotection.org. We also receive support from the North American Securities Administrators Association, known as NASA. It's the oldest international investor protection organization. NASA's members include state and provincial securities regulators from the U.S., Canada, and Mexico who serve on the front lines of investor protection. Recognizing that education and awareness are powerful tools in the fight against investment fraud, NASA is pleased to sponsor Friends Talk Money. Here are 3 important tips to help you protect your money from fraud. With investing, there are always risks, so be cautious of anybody telling you that a certain investment is guaranteed. You should also proceed with caution if somebody is promising very large investment returns. This is a common red flag for investment fraud. Last and most importantly, be sure you're working with a licensed or registered financial professional. You can check your advisor and make sure they're licensed by visiting brokercheck.finra.org. NASA is your partner in keeping you safe and helping you avoid investment frauds. Visit nasa.org and click on the Investor Education tab to learn more.